Welcome back, investors, to Ticker Time News. I'm Adam, and better than expected CPI data sent the stock market ripping higher today. And let me pause real quick. I am rushing to get this live stream done. We're getting a massive thunderstorm here, and I don't want the electricity to go out like it did last Friday and me not to be able to come live and talk to you about this big ripping tear of a day that we had in the market. And of course, talk about the CPI data. So I am going to go a little bit faster than normal just so I can, fingers crossed, to get through it. But if we do lose connection, that's why. So please excuse me in advance if that does happen. Okay, the three main indices saw some up and down price action day, but ultimately they closed higher with sizable gains. The S&P 500, it reached the 4,200 level and it broke above. And let me get the highlighter out. Should have done that already. The end of May, beginning of June, that we've talked about a ton of times, the similarities, that similarity was broken. History rhymes, but it doesn't repeat. Today, we closed above the high set during that period that we just could not break above. And it was 42.77. That was the big number, and we broke it. And actually, let me back up a second. Reverse. 41.77, excuse me, getting ahead of myself there, thinking about where this rally could be going, right? So the high then on June the 2nd was 41.77. We broke that today. We closed above it, 42.10. Congratulations. Now that resistance area is broken and the market can rally now to the next area of resistance, which will be up here. This red line now up here, and this is sitting at 4,300. That'll be the next area to slow this market down. But of course, from now till the market close on Friday, we have the upper expected move for the S&P 500, which is sitting at 42.32. That'll be a bit of a slowdown zone. Not big resistance. It can break it. The options market is correct. There's one of those big thunder strikes. The options market is correct 68% of the time, so it can fall out of that. However, you see this light green line that is running this way across the screen, and it connects right here about where Friday would be at the weekly expected move. And let me go out just a little bit and show you where this line originates from. It's a very interesting line. Let me just put it that way. Hold on, got to click one more button here. There we go. Now let me zoom out a little bit further. Look at that. It starts at the peak of 2019, right? The 2019 high. We haven't talked about it in a while. The 2019 theory, a lot of stocks broke their 2019 highs. But that's where this line starts off of, and it makes a few interesting connections along the way. However, if we can break that line, that's signaling to me that, okay, my market thesis, I need to update it. I need to stay fluid with the market, and I need to tweak it because this market could very easily continue to rally throughout the rest of August and into September. Now, let's talk about the moderation in both CPI and core CPI, just real quick. The main driving factor for the market today was this report right here. It fueled the notion that the Fed will be less aggressive with its rate hike path and switch to a rate cut cycle sooner rather than later. Now, my thoughts on that are not what the market thinks. The Fed is not going to cut rates in September. They're not doing it. They will raise rates in September. Because even though inflation came down to 8.5%, that's still a big number for inflation. And if we look at what really moved the CPI report, we have food right here, right? food actually increased month over month, 1% in June to 1.1% in July. So food did not go down. Food at home up 1% in June, up 1.3% in July. Food did not go down. So even though the CPI year over year headline number was 8.5%, it is still a high number, and food did not come down. What brought this number down was energy commodities. Look at this. Energy commodities from 10.4% to negative 7.6%. Right here, gasoline, all types, 11.2% in June, negative 7.7% in July. And then I have to go down a couple of lines here. Then we have electricity, 8.2% in June, negative 3.6% in July. So that is the section of the CPI report that pulled the overall number down. However, when you look at food, what consumers are spending the most to fill our bellies and keep us alive did not go down. That inflation actually ticked up. So just keep that in mind. Another area that ticked up was medical care commodities. That went from 0.4% in June to 0.6% in July. So that ticked up as well. So it's not all good things in here. There were a few bad things. Now, one thing that worried me was shelter, okay? Shelter did tick down. It went from 0.6% to 0.5% from June to July. So not a big drop or a big difference between the two, but it did tick down, which is a good sign. And that was one of my red flags that I was concerned about with the CPI report. So just pointing that out right now. Okay, total CPI, it was unchanged. And I guess I should go back here real quick. It was unchanged month over month. In core CPI, it was up 0.3%. So again, from now until September, the market has no catalyst to hold it back. The earnings season is just about over, almost over, and it wasn't as bad as feared. Remember the question a live streamer or so ago? Why is bad news perceived as good news? Because it's better than feared. Okay, so we have that. Now the market, it can rally until the jobs report, the CPI report, and the FOMC meeting that happens in September. Those three things are the next big catalyst for the market, and they don't occur until September. So the market literally has from here until September that it can rally without big negative catalyst in its way. So that's one thing that is I'm updating with my market thesis right now today. Since CPI came in better than expected, not just better than feared, but better than expected, the market can obviously run until September in those three big things: jobs, CPI, and FOMC meeting. And I still do not believe, like I already said, that the Fed will not raise rates. I think the Fed will raise rates in September, but we have one more CPI report until the FOMC meeting, so we'll see. That's where I stand right now. Those calls are up 200%. Awesome. Yeah, I cut my losers real quick this morning and then let my runners just keep on running. I am still holding them because I think there is more juice in the tank for this market. Obviously, if we look at the S&P 500 here, there is a big gap right here now that was left today that will at some point need to get filled. So we have that. The same thing is true on the SPY. There was another big gap up. As a matter of fact, just about any chart you look at, there was some kind of a gap up today. Talking about the SPY just real quick, 422 is the top end of the weekly expected move. We can totally get there. We could even knock that out. I think, 430 is the next real area of resistance, which is where this red line is here, which are the highs that were set back here in the end of April, the beginning of May. May 5th was the last high, and that was at 429.66. So 430 is the next big resistance area for the SPY. Looking at the Qs, nearly identical, a huge gap up. It's going up to that area of resistance. But however, for the Nasdaq, for the Qs, the next resistance area is actually slightly under the weekly expected move. There's a red line here right underneath it. It's at about 330, where the weekly expected move is 331. That'll be the next area of resistance for the Qs. Now, today, the dollar broke down, and that helped the market to rally. As a matter of fact, there's this blue line here. I drew this blue wedge pattern, symmetrical triangle here yesterday, and saying, you know what? Tomorrow, this thing is going to break out one way or the other, up or down, depending on CPI numbers. And that's exactly what happened. It broke down because the numbers were good. The dollar is down 1% on the day. That's about where it closed there. It did drop further. Now, for the dollar, it does have some support right here at 105. But the next area, if it breaks that, it's really looking at 103 as the next area that could step in as support. And if I put a trend line or a support resistance line there, it's almost like a zone. There's a few dollar difference, pennies. Let me line that up right there. That would be the next area that the dollar could drop down to, and that's at about 103. Okay, moving on. Mega caps today, growth stocks, even cyclical sectors, it led the way after those areas sold off heavily in recent sessions. As a matter of fact, if we look at the Qs again, and the Nasdaq, it's now in bull market territory. Remember, when we're at a high and we fall 20%, you're technically then in a bear market. Well, the reverse is true. When you're at a low and you rally 20%, you are then technically in a bull market. That is what happened with the Nasdaq today and the Qs. It is now technically in a bull market because it's up 20% or more from, again, those lows that were set. Let's see, this would be June 16th. That's interesting, right? So the Vanguard, not Megagard, the Vanguard Mega Cap Growth ETF, ticker symbol MGK, it was up 2.9%. While the Qs were up 8%. That's ahead of the broader market. Then we look at the Russell 3000 Growth Index. It was up 2.7% today, and it closed ahead of the Russell 3000 Value Index, which was up 1.9%. Then we go look at the semiconductors today. They completely reversed course. Let me find my sectors here and bring them up. The Vanguard Semiconductor ETF, the ticker symbol is SMH right here. It was up just over 4%. Remember, yesterday it fell hard. We had Micron saying that, we're going to lower our expectations for revenue. The day before that, NVIDIA doing the same thing. Today, it bounced back up into its weekly expected move. That happens a lot. Whether or not CPI was good or bad, that's something that could have happened because the options market is right 68% of the time. Okay. With today's CPI report and the semiconductors here, don't forget about their warnings. Their warnings still stand true. What Micron said yesterday and what NVIDIA said the day before, revenue is being hurt at those companies. Don't let the excitement of this market cause you to lose track of that information. I wasn't sure what words to use there. The market will rally at least for 2 weeks, I think, until we get into September. Once we're there, there's big catalyst again, like I mentioned at the beginning of the live stream here. Until then, we'll have companies come out and they will lower expectations. That'll still happen, and that can shake the market some. So there will be growth concerns in this market that will come out, right? Those growth concerns could be viewed as reasons for the market to rally, because market participants will think, well, if there's growth concerns, the Fed will not raise rates. But I'm telling you, until inflation comes down substantially, I mean, it'll have to come down to 4% or less, I think. The Fed will raise rates until that point. An 8.5 reading, inflation is still high. The Fed will still raise rates. So this market could front run again the potential of the Fed lowering rates, doing a Fed pivot. But it's not going to happen as soon as they think it is. At least that's my opinion. It will eventually happen one day, maybe first quarter of 23, maybe second quarter of 23. I don't know. Don't have a crystal ball. Okay, but I don't want to ruin the feel-good juices that we all have today from the market being up, right? It was great. Okay, so semiconductor index up 4% today. The S&P 500 sector performance, you can see it on the right-hand side of your screen here. All the 11 S&P 500 sectors going from the top to the bottom, all up. The first red number you get, that's the DXY, which is the dollar, or Dixie, down 1%. But all 11 S&P 500 sectors, it was a reflection of risk on mindset. The materials sector up 2.9%. Consumer discretionary up 2.9%. Communication services up 2.8%. Information technology up 2.8%. Big mega caps in those sectors. And those were the sectors that topped the leaderboard here. We can see those right here again on the right-hand side of your screen. The buying was obviously broad-based, with all of these sectors being green. The gains ranged. It looks like the lowest gain here is 0.44%, and that's utilities. The top looks to be 2.9% materials. That's your range in the S&P 500, the 11 S&P 500 sectors. Now, the Invesco S&P 500 equal weight ETF, which, spreads everything out evenly, equal weight, it even was up 2.1% on the day. So market breadth showed a strong skew towards advancing issues, stocks going up. And as a matter of fact, advancers led decliners by about a 6-to-1 margin at the New York Stock Exchange and about a 3-to-1 margin at the Nasdaq. Now, pushing back against the market's notion of a policy pivot in the near future. Fed President oh my gosh, I always get this name. It's the Minnesota Fed President. I am pronouncing it wrong. I apologize. But is a 2023 FOMC voter. He thinks that the terminal rate is 3.9%. That's where the Fed needs to get inflation down to. And again, I said 4% just a few moments ago. And then adding to that, the Fed is, and he said many, many times, far, I can't remember how many fars, but several fars away, far away from declaring a victory on inflation. And then you had Fed President Evans, who's not an FOMC voter, said that he expects rates to top out at 4%. But he also said, if things get better more quickly, we can not raise rates quite as much. So again, The data will drive the Fed's decision on pivots, on rate hikes. Okay? So just keep that in mind. But from now until then, September, we've got really nothing that big to worry about. Treasury yields, let's talk about them. US 02Y. Treasury yields fell sharply immediately after the CPI report came out. The 2-year, which was at 3.27, and let me bring this up. 3.27 is not where it closed, but listen here for a second. It was 3.27 just before the news came out, and then immediately dropped to 3.08% in the wake of the news. And it finally settled today at 3.19%. It is up slightly here in the after hours to 3.22%. And then we look at the 10-year. US 10Y. The 10-year, it was at 2.8% just before the CPI data came out. And then it fell to 2.69% in the wake of the news. But it gave everything back and settled at 2.79% at the close. In the after hours, it is flat. It is flat here in the after hours at 2.79%. Now, before tomorrow's open, we get a few earnings reports. Those won't have a big impact on the overall market. They can have impacts in sectors or subsectors that they're in if things are way off whack, right? If misses are really big, if they say that if they project that their guidance is going to miss expectations, those are things that can affect individual stocks, individual, subsectors, categories, or sectors themselves, but not necessarily the broader markets. So just keep that in mind. The broader markets don't have big catalysts until September now, which that has to make you think, right? I think the market can rally through August. I think it can slowly just creep up. I don't think we're going to have big explosive days, but I think we can have a majority of them being green and the minority being red. And we slowly tick up and to the right on the charts. Okay, let's see here. I know I went through this quick today. That's just because of the thunderstorm, and I didn't want to lose the electricity and then miss out on this with you guys here today. Let me think here. I think I've gotten everything that I wanted to say. So let me just say this real quick. Tomorrow, I guess I should say there's one more piece of data that comes out tomorrow that could affect the markets. However, that's it. I totally forgot this when I was saying this. We get the PPI, which is the Producer Price Index. That comes out tomorrow at 8:30 a.m. The expectation is 0.3%. Prior reading was 1.1%. So that's a big drop. And then core PPI, the expectation is 0.4%. And that's the exact same from last month, 0.4%. Again, 8:30 a.m. Eastern. Not as big as CPI. It's what producers pay, not what consumers pay. With consumer price index coming down, mainly because of energy, oil, then I would have to believe that the producer price index has come down too. Maybe not as much as the consumer price index, because you have to think when we go back to the consumer price index and we're looking for outside of energy, we've got, when we look at commodities less food, which is new vehicles, it went from 0.7 to 0.6. Used cars, 1.6 in June to negative 0.4 in July. Apparel 0.8 to negative 0.1. Medical, that went up. Services, less energy, 0.7 in June, down to 0.4 in July. So the producers use a lot of energy, just like consumers do. And with that dropping big, I think there will be no problem with PPI coming down. Oh, I see. PPI, yep. So those are the expectations for the producer price index. And I think it will come down. It could very well meet expectations or even, be better than expectations. But you also have to remember that what the consumer is buying too, especially in apparel, remember, inventories have been high. When inventories are high at companies, what do they do to offload that inventory? They will reduce prices. That's where you get your sales. Try to get rid of, last season's merchandise. So that's something that helped with the CPI. Another thing here, while I'm thinking about this, shelter, since it did come down in the CPI, then you would have to think that, rents for, producers would come down too. Their input cost should come down with oil coming down. Oil is tied to everything. So I think that's a pretty good bet that it at least meets expectations. I don't think it'll come in hot, even though we're talking about, two different spheres here of the world. Are you swinging? Yep. My calls are in. I am locked in. I did not pull the cord on them. They are running right now. I will let them run until one of two things. And let's let the chart load here for a minute. 4,300 would be, I would be out at 4,300 on the S&P 500. I would start taking profits. Once we cross the weekly expected move, I would begin taking profits then. Because I don't want this to get outside of the weekly expected move and then be pulled back in on Friday to close within it. So once it breaks that, I'll start taking profits and then be completely out by 4,300 and then reassess, or maybe if the market gets to a point where maybe it's just above the weekly expected move at 42.32, maybe the market starts to contract and digest this information that it got today with the CPI, tomorrow with PPI, then maybe close out at that point. But right now, I'm running until we break the weekly expected move. Then I start taking profit, and then I would be completely out at 4,300. Now, if we look at the SPY, that same strategy would work in this way. Let it load here. Let it run until we get to the weekly expected move, which we're not far off. It's 422. And we're at 419 right now. Almost closed at 420. 422, start taking profits and then letting it run to 430. Maybe taking profits along the way. Probably take a third once it reaches the weekly expected move at 422. Taking another third halfway between maybe about 425, and then leaving the final third to run until 430. That would be my strategy on the SPY for taking out profits. I usually do thirds at a time. If we're looking at the Qs, that's a little different story. Let that load here. All right, for the Qs here, we're at 325, and there's probably resistance around 329, 330, and then the weekly expected move is at 331. So at about 330 on the SPY, that's when I would start taking profit. If it gets hung up at 330 and it can't break above this resistance and it starts to look like it's going to go through contraction, consolidation to digest this week's information, then I would close it out. Because unlike the SPY has room to run a little bit until it gets to further resistance, where the Qs have run a bit hotter and it's getting really close to that resistance from April. I'm also swinging my calls. Awesome. Good luck. I hope that works out for us. So far, so good, right? So that would be my plan for them. Is there another indice that you want me to look at, or another sector or stock? I have reached the end of my notes for today. And again, I ran through it quickly. And, well, the lights just flickered. It looks like, looks like the wind's calmed down at least. What was I going to do here? I totally forget. Oh, let me pull the VIX up, because that's a big part of this story. Yeah, I did mention semis. I'll pull them back up here in just a moment. The VIX, obviously, with a big run up like this, with the dollar losing a whole percentage point, the VIX just completely broke down today. It is now sub 20. It closed at 1974. I'll pull it up here so you can see it more clearly. It closed at 1974, down 9.3% today. That's really, really good. And one thing that I'll point out here with the VIX dropping like this, a lower VIX means that we're going to have lower swings in the market, right? When the VIX goes down, we don't have those big, 5, 10% swings in the market. It goes down to much easier swings in the market. However, that's the opposite, at least from a report that I read on Bitcoin and cryptocurrency and the VIX and volatility. When the VIX goes down, sometimes you get the more explosive moves, especially to the upside in cryptocurrency. And if we look at Ethereum just made a pretty big break today. This Ethereum has this resistance that was back here, June the 5th. This was something huge that Ethereum needed to break, and it broke it today. Although it closed right on it, but it did break through it. Let me put this trend line here. And you can see how it matches right up here with it. So that's really good for Ethereum breaking through this. Now it needs to close, and then the next area for Ethereum will be its 200-day moving average, which currently sits at 2267. Can you imagine? This thing was, what is this? Sub $1,000 just a few months ago. And now it's getting ready to cross 2,000. And you can see 1859.6 1861, 1860. That's where it's at right now. So Ethereum, it's a good mover. Now, a lot of people use Ethereum to the dollar to look at things. I like to use ETH, and this is something new. Ethereum to Bitcoin, and I still use Coinbase here. I think that shows you a little clearly, or a little clearer, the setups that Ethereum is making. And this is something new for me. I used to always just use Ethereum or Bitcoin to the dollar, but using Ethereum to Bitcoin, I think it gives much cleaner and clearer setups. Because look at the chart in front of you. I mean, we have got a rising wedge that was forming here on Ethereum. When we take it to Bitcoin, Ethereum to Bitcoin, let me just throw this one more line up here. And you can see, look at this. That is definitely bullish. That is big time bullish. You have this big rally and then this flagging or ascending wedge here. I mean, that's bullish. But if you're looking at Ethereum to the dollar, that pattern is not as clear, right? Yeah, there was a run up. Sure, you could draw the same lines, but it doesn't look nearly as aggressive or as bullish as it does when you use Ethereum to Bitcoin. So that's something new that I've been working with that I think gives a much clearer picture for the move Ethereum is making. So just keep that in mind. Okay, so for semis, the Vanguard semiconductor ETF was up 4%. And when I was talking about semiconductors earlier, the important thing to remember is the news that Micron shared yesterday, the news that NVIDIA shared the day before that. Those bits of news should not be discounted because the market rallied so aggressively today because of CPI being down. That information is still valid. As we move through, we get out of this earnings season, which we're almost out of, and then we move to Q3 earnings season, and then we move into guidance for Q4. More and more companies are still going to be announcing, I believe, that, well, you know what? Revenue isn't as strong as we anticipated or expected. And they're going to have to bring down their expectations. So Micron and NVIDIA, don't let that news slip your mind because of the fun we had in the market today and the fun that we could have for the next 2 weeks. Growth concerns are still there. So that was my main message when we were talking about the semiconductor sector. And it's true for all sectors, especially technology is the bigger one there. But then you look at the news from the trade desk. What is that? Is that TTD? Yeah. The trade desk exploded today. I mean, like a missile. What was this? This thing was up 50. Was it 50 some percent? 36%. 36.2%. I don't know why I thought it was 50. There was something else that was up 50 today. I can't remember now. But the trade desk, this is like online advertising. They missed on earnings. Look at this. Barely 1.35%. They did beat on revenue. But their guidance wasn't as bad as expected. And this thing took off. So there will be news out there that's positive, that says, growth is okay. But you compare, the trade desk to other online advertising platforms like maybe Google or Facebook, Meta or Snap. Some of the reports aren't good. Snap definitely wasn't. So it is interesting out there. But growth concerns are still there. The economy is still slowing down. Jobs are weakening. Even though we had the big jobs report, it's a lagging indicator. So we had a great day today in the market. I think we can have a great 2 weeks in the market. I think we can have more green days than red days until September. The next big catalyst, jobs report, CPI, FOMC, all three occur in September. The FOMC meeting in September is September 20 and September 21st. There is no Fed meeting in August. So no more big catalyst until September. Of course, we do have individual company catalysts that are out there, but overall, for the broader market, not until September. So we can have a nice run up. Euphoria for now, yes. We can have a nice run up for the next 2 weeks. Maybe we can even break out some of these other resistance areas. And I don't think this is a 2-week rally that's going to take us back to all-time highs. No, that's not the type of rally I'm talking about. But because what is that? What was the high? It's all the way up here. Oh, almost there. 48.20. Is that what it was? 48.20. The closing high was 47.96. The intraday high was 48.18. I'm not thinking we're doing that. I could be wrong, but I think we'll have a bullish ride until September. Yeah, I can take that red line out because we broke that resistance today, but boy, did we leave a big gap. When we leave big gaps like that, that does make me a little nervous that, hey, it's possible that we could, all gaps must be filled, right? Look at that. That is a huge gap to be filled. And that's not quite all of it either. All right. Just leave that. Oh, man, that's a huge gap. All right. So I'll just leave that there for now. That is a gap that you don't have to get filled, which makes you think. But at least for the next 2 weeks, I think we can easily get to 4,300. If we break 4,300, the 200-day moving average, if we continue to rally, that 200-day moving average that is starting to level out, still descending, oh, what did I click on? I clicked on the wrong thing. It's still sloping down, but it'll start flattening out more if we continue to rally. And then, of course, that may line up right with 4,300 by the time we get there. And that, of course, too, would act as resistance. So we could have, 2 points of resistance right here together at about 4,300. So I guess that's my price target for the next couple weeks is 4,300 or 430 on the SPY. And we'll see if we can reach that. But the growth concerns are still there. And we'll have to face those at some point. Inflation is still high, 8.5%, still a big number. So the Fed will still raise rates. The Fed will not pivot in September. But we're definitely not looking at a full percentage point raise. We are looking at maybe a 50 basis point, maybe not 75. Let's see. I'm just checking to see what expectation for rates are. All right. Remember last time we looked at this, there was a bigger percentage chance of a 75 basis point. Now it's a 57.5% chance of a 50 basis point rate hike, a 42.5% chance of a 75 basis point rate hike. So that's what the Fed Watch tool is projecting at this moment in time, and that is for the September 21 date. So these were reversed, 2 live streams ago when we looked at this? And now they are showing a 50 basis point rate hike for September. Okay, cool. Well, I will wrap it up here. It looks like the thunderstorm went by, so it was nothing for me to worry about. But since the lights flickered, I just want to get it out quickly so we had our information out. All right, cool. If you could click that like button, that would be gratefully appreciated. And I'll see you back here tomorrow after the market has closed. And we'll talk about the weekly expected moves and see how, well, wait a second. It's not Friday yet. Hold on. Tomorrow's only Thursday. Don't get too far. We'll talk about the PPI tomorrow, Producer Price Index, and how that came out. That can affect the market tomorrow, and that's the last, major catalyst that the market will have for the next 2 weeks. So once we get past that, it is pretty smooth sailing, it seems like, at least at this moment in time for the market. Okay, well, thank you for joining me today. I greatly appreciate it. And one more thing I want to just say, if you want a ton of information to help you along your investor journey, click the first link in the description. Come join us on Patreon. The information is awesome. Weekly expected moves, trade setups, top 10 stocks, 4 different categories, market insights, economic data insights, all kinds of information to help you with your investor journey. So consider doing that. It helps out the channel too. So I greatly appreciate all of our members. I love you guys. Thank you. And I'll see you tomorrow after the market's closed. Thank you. Have a good night.